Hey, everybody. Hopefully you're killing it. Hopefully you're having a good day. Hopefully you're having some fun trading if you're trading. I mainly invest. I don't trade too much. But my name's Andy. My channel's Finding Value. If you like making money, if you like looking at commodities, undervalued sectors, this is the channel for you. Subscribe to the channel. Give me a thumbs up if you like this content. Try to get in the picture there. So today I'm going to talk about precious metals prices. I'm going to go over a couple of precious metals so you guys understand kind of what the costs are. I call it the cost curve for that commodity. It's silver, platinum, and gold. I'm going to show you some, we'll call it prices that some of these producers produce at, and show you what I look at when I'm investing in companies. So let's get into this presentation. I call it the precious metals prices presentation. So price movements. Prices move between demand and supply. When prices fall, typically they fall below the mining costs of the higher producers, and then production falls. When prices move above higher cost producers, supply rises and new supply comes online. Technology can lower the cost of production while being offset by inflating money supplies. The longer the price remains below a commodity production, usually the higher the spike in price later on of that commodity. Investors can cause major spikes and lows as they amplify the moves with retail investors chasing price movements. And that happens very much so in the precious metals area, where investors start to see a price move. They all pile in, causing a larger price move. Then on the backside, they also tend to sell and dump all at once. So here is the global primary silver mine production costs in 2019. And here's the price. It was $16.21 an ounce in 2019. And this is the total cash cost in the purple and all-in sustaining costs in the green. So you can see that we've got some production that could potentially come online in the $25 to $30 range up here. But a lot of the producers, this is in the cumulative silver production, the percent, and this is the price on this side. The percent, 90%, I would say, are at $16 and lower. So $16 and lower, 90%. The last 10%, which are basically the swing producers, are up in the $25, $30 range to turn those production mines on. And sometimes it's not just a flip of a switch, it takes time. Here's the silver plays and their operating costs. This was in first quarter of 2017, so it's a little older, but I think they're pretty similar to today. So Silvercorp, Fortuna, and Avino are the low-cost producers. These guys probably won't move as much. The higher cost producers on the other end, I would say, are First Majestic, Hecla, Great Panther, Endeavor, and Coeur, however you say that. So I like Endeavor quite a bit because it's a higher cost producer. Got a lot of leverage, and they call it torque to the price. Global silver production. This is the global silver production. This is the years. This is the silver production amount. You can see we kind of been going up. 2016, we pulled back a little bit, and they think it's going to go up coming up here. That's the estimates by global data. This is platinum here. So we're switching gears to platinum. This is the South African platinum mines cost curve of 2017. South Africa is the largest production of platinum. They approximately produce 80% of the world's platinum. So if you look at this, and we were hanging out below $1,000 an ounce, the mid-cost producers are at about $1,000 an ounce right here. These are the high-cost producers. Here's Impala Platinum there. That's at $1,200. And there's some other ones above that. But down here, these are the really low-cost producers. It's around $800. And when we got down to $600 in that one March-April timeframe, it was in March, where platinum had that spike down low and I was buying like hell, that was an unsustainable price because it was below the price of all of the producers in South Africa. And these are the low-cost producers. It was below that for a little while. And that is an absolute opportunity of a lifetime to be buying it at that price. And I bought as much as I could when I could. Primary platinum supply. These are the production, and they estimate this to be declining over time. Not going up, but declining. Pretty crazy. Here is gold's cost curve. I want to touch on all the precious metals, the main precious metals. So this is like $950 for the lower ones. The mid ones go up to maybe $1,200, and then the high cost ones all the way up to maybe $1,500. So we are above, gold is, the high cost producers. So we don't have as much of a cushion here from a cost curve perspective. So let's look at the supply side. The supply side, oh, wow, look at this, guys. 2020, we've got a forecast of a decline in production of gold going forward. This is very bullish for gold, as if this does occur and we have a flood of money coming into it, you're going to have less and less supply with more and more money going after fewer ounces. So this could be an opportunity, if you like gold, to lock in some physical gold or whatever you like playing it with, and just hold on. Here's gold production from new and existing sources from a different source. This is KC Research. They've got a peak or basically a plateau from 2019 all the way to about 2022 is a plateau with the probable new production. Then a decline from that after. So it's within about a year or two of the other one. So it looks like gold's going to potentially decline over time. So my opinion and what I've done is I've loaded up in silver and platinum because of the ratios. And I didn't show ratios here, but the ratios of platinum and the ratios of silver were extremely cheap when they were down there. And I was buying below the cost curves of production of the mid-tier producers. I was buying below them. Whenever you have an opportunity that you can do that, you load up, because, and especially with physical metal, because they're going to have to go, the price has to go higher. It has to go higher. If it goes lower, it's only temporary and you continue to cost average in. What I see coming up is I see demand shooting up for platinum and for silver in the years out to come. We're going to see investors pile in here. And typically what happens is the investors buy up all the metals. It goes bare. The inventory gets drawn down. Prices shoot up. And then the industrial users say, crap, I got to buy this stuff. And then everybody comes in, starts buying it, pushing the prices much higher than where they are today. So what I like to do is buy when the ratios are cheap. You just buy, you sit on it, you cost average in, and you just sit there and wait. If you're fully loaded with this stuff, you sit there and wait, and you wait for the price to go up when everyone else comes rushing in later. That rushing in, I think, is coming now. So I have been buying and cost averaging into still silver mining companies, and I'm looking for opportunities anywhere else, copper, nickel. I mean, all these, I think it's coming, and the money's going to rotate to these sectors, pushing these things far higher than where they are today. That includes oil and natural gas as well, the energy sector, and uranium, all of them. So when that money floods in, you're going to see a big move to the upside. Now, I know some people, they want to try timing the market. They want to sell for some profits and sell at a peak and buy in. Problem is, some of these things don't really peak. They just continue to go up. So they can shake you out, the bull market, and then you never get back in because you don't have that psychological, like you've got that being where you're chasing it. So if you go into a sideways pattern that goes back and forth like this, you buy at a top thinking that it's going to break out, and then you sell at a bottom, and then you buy back in when it goes back up, and you're just losing money hand over fist trying to go in and out of these things. Or if the company comes up, it has a little bit of a pullback, you sell when it's pulling back, and then it shoots on up 20, 30, 40% higher. You're going, damn, I just missed that. That happened to me on the back end when it was really volatile of the blow off top. And it almost, I missed it last bull market. I'm not selling this bull market. I'm not going in and out. I'm not taking profits. The only time I'll sell something is if I see a better opportunity somewhere else. I'll take my original investment out and put it into that one. That is it. I'm not trading in and out. I'm not trying to time anything. I'm going to stay in and continue to cost average into what I think are the best opportunities at that time, spread my money out, and just hold on. If you guys like this content, subscribe to the channel. Give me a thumbs up. Leave comments below on what you guys think. Hopefully this helps you out in investing. This is what I look at when I invest in commodity companies. Cost curves, supply and demand balance. I look at what does the supply look like going in the future? Is it declining, increasing? What's the demand look like? I look at all that stuff. I just wanted to show you some of this stuff that I've seen for the precious metals so you guys are up to speed on what I know. Thanks for listening. This is Finding Value.